Hi, everyone. This is Jason Burek of Wall Street from East Street. Welcome back to another Wall Street from East Street podcast interview. Today's special guest is a first-time guest, but I've known him for a couple years now, and I've learned a lot about the precious metal markets from him. He also has a very large financial background experience. His website is Smile Gold. It's a blog that focuses on the economy, real estate, gold, and silver. Louis Cammarosano, thank you for joining me.
Thanks for having me, Jason. How are you today?
I'm pretty good. We're actually just trying to stay warm, and we're about to get 20, 30 inches of snow here in the Washington, D.C. metro area, so that's going to be fun over the next couple of days. Not.
Yeah, exactly. Good luck with that.
Well, Louis, you have some very interesting views about the gold and silver market. I want to ask you about them during this interview, but first, let's talk about how you view the economy right now. You know, there's a lot of potential black swans out there. In fact, I think I see more black swans than white swans at this point. Do you think then that the global asset markets and the global economy are set up then for some type of crash in the near future?
I think it all comes down to the oil market and the dollar, Jason. What's happening is we had the Federal Reserve raise rates. And I was saying all along that the reason the Fed would raise rates is that they're concerned about the dollar. The Fed's concern, I think, Jason, is not about protecting the too-big-to-fail banks. It's not about full employment. It's not about getting the economy going. It's basically maintaining the dollar hegemony. And in order to do that, they raised rates. And one of the reasons that oil prices are lower was because we had all that shale oil being pumped into the market. And you and I have discussed that, yes, there has been a decline in oil demand, but clearly there's a lot of supply coming onto the market. And that came from the United States. It comes from Saudi Arabia. And to me, what I think is going on right now, Jason, is the United States is flexing its muscles across the board with the dollar. Obama said I think it was a National Public Radio interview about a year ago that Russia couldn't take low oil prices for too long. I think that Obama is very upset that a lot of people in the media and even in the alternative media have this hero worship of Putin. They say Putin plays chess, Obama plays checkers. I think he had enough of that, and he wants the oil price to go down for two reasons, and it fits in what the Treasury wants too. If oil prices are low, that means people start, if the shale oil companies go out of business, that's good for green energy, right? Because that's what the Obama administration wants is green energy. The bankers want low oil prices too. Even though they're exposed, Jason, they're exposed because of the money that they've lent to shale oil companies. But unlike in the mortgage business, when they lent a lot of money, they got stuck with houses. Well, in this case, they can get stuck with the oil fields. And once they have the oil fields and the oil companies, because of their debt covenants, then the banks control oil. And as you've known, all along, there's always been this bankers lobby versus the oil lobby. Well, bankers always win because they can always take an asset, monetize it, securitize it, do whatever they want. They can print money. Oil people can't do that. You can't create more assets you can't make more gold, you can't really make more oil, but bankers can control things this way. So I think what's happening is the dollar is being promoted by raising rates, and the United States government, Fed, telling the other banks, Bank of Japan, European Central Bank, Bank of Switzerland, keep your rates low. Okay, it'll help your economy. Meanwhile, the U.S. raised rates when it made absolutely no sense to raise them. But that makes the dollar stronger. So with the dollar stronger, you now have a situation where the Fed can actually do one more rate hike and really put the nail in the coffin. So as Saudi Arabia is pumping more oil, the United States can turn around in a year from now, after the shale companies have kind of gone out of business. Now you have lower supply. The banks own those. They've had Iran bring on more oil. So you've got this situation where there's so much oil being pumped, but at some point, as you and I discussed, it's all going to come crashing down because oil production will just cease. And at that point, the bankers can engineer a rise in the price of oil again. Restart those shale oil companies, get the higher price, and also reinvest that money that they make in green energy. So I think this whole thing is about the dollar, green energy, and controlling the financial world through the use of manipulating interest rates, the dollar, and the price of oil. I don't think that this thing came out of, this isn't a black swan. I think this has been engineered to crash the price of oil. And also, the Iran deal, bringing all that oil online, that deal made no sense other than there has to be some other reason. Why did they want Iran to become a international oil supplier? Well, there's already oil coming out of everyone's ears. Other than they want to pile on and drive the price down. And Saudi Arabia was also probably annoyed at the United States that we were producing a lot of oil, and that was taking Saudi Arabia's its only card out of its hands, because the Petro Dollar is important to the United States because people need dollar reserves. They buy treasury bonds so that they can buy oil, because Saudi Arabia only prices and sells oil in dollars. But if the United States is producing as much oil as Saudi Arabia or more and exporting it, the U.S. doesn't even need Saudi Arabia to do that, because the U.S. becomes the exporter. So I think the United States has played this very cleverly. You would think they should be kowtowing to Saudi Arabia, but instead they did that with Iran, and they brought more oil onto the market, which wouldn't make any sense unless you realize that the bankers are trying to control the oil industry in the United States by creating a glut and then a shutdown in production and engineer a price rise.
That's an interesting theory. Now, my personal opinion of Iran and why they're increasing oil production is they're broke like a lot of the other oil-producing countries. You know, they have bills to pay, and they're willing to sell the oil at any price just to raise cash.
Right.
So
yeah, but why? That was always the case, though. But why was the United States anxious to give them that break? Remember at one point John Kerry said, if we don't get this deal done, the dollar's position as the world's reserve currency is at risk. Did you hear him say that?
I did, but I didn't hear the full context of it. And, you know, you don't know if these guys are telling the truth or not. See, that's the thing. I'm very skeptical of these politicians and diplomats and stuff like that saying stuff out in public. You don't know if they're telling the truth or not.
Well, I didn't hear much around it and why it was a threat. And it just seems to me that perhaps Iran had already made arrangements to sell oil to Russia and to China, not in dollars.
Well, Saudi Arabia and Iran don't get along,
Correct.
so, I mean, maybe they're in an oil price war for market share. So I've heard that theory bandied about, but, you know, who knows? I know the oil market's not a free market, and I know, obviously, when you have a cartel like OPEC involved, there's attempts to manipulate the price up for different reasons and manipulate the price down for different reasons. Most people think cartels only want to manipulate the price up, but cartels also are willing to, you know, manipulate the price down temporarily to wipe out the competitors, right?
Yes.
But it seems to me that things have basically turned into a tug of war now, and you kind of alluded to this, but I'll color in the lines here for you with my opinion. But it seems that, you know, you have OPEC and the Saudis on one side, right, with the majority of the oil supply, but you have the shale producers on the other side, but they're backed by the Wall Street banks and the Fed. These guys have been insolvent. The shale producers, they've been producing uneconomic oil for a while now. So they've been, you know, running at losses, and yet, you know, they just keep somehow able to get more debt and keep producing when, you know, financially they shouldn't be able to. Someone should have called in the loans or things like that. So there's definitely financial games, financial engineering or whatever going on behind the scenes. None of this would have been possible for all these shale oil producers to get all this money with, you know, prudent lending standards.
No, QE and zero interest rate policy caused the malinvestment in shale oil. It's an overinvestment and the reason, you know, that banks feel that they can make malinvestments is because they don't think they're malinvestments. They know they can reap the benefits of a malinvestment while during the entire period, And then if it goes wrong, they know that the government has its back. Maybe they won't bail out the banks, but what's to stop the government from bailing out the shale oil companies once they're owned by the banks in national interest?
That's a good point. I mean, the rules, and you read my report that I put out, and I think our listeners, rule number one, the rules are going to change. You're a lawyer, Louis. You are a lawyer, and I live right outside of Washington, D.C. We have the largest amount of lawyers per capita here. I think that and New York City. And, when the rules change, when things don't benefit the government or special interest group or corporation, they hire a lobbyist and a group of lawyers to change the rules for them. So I think that's what's going to happen going forward, and that's why a lot of people, they're going to be caught dumbfounded by all the rules change. It's going to be very frustrating for the buy and hold investor or the person who put all of his money just in physical precious metals in the United States and storing it, especially gold. Although I don't think they're going to go after silver as much with any potential windfall profits.
When you say they're going to go after gold, what do you mean, Jason?
Well, maybe what FDR did. So if they do confiscate or nationalize or whatever you want to call it, they're going to force you back into paper money again.
But so few people have physical precious metals. I mean, most gold investors, if you can call them investors, are in paper gold. They're in ETFs or they trade COMEX contracts. The number of people that actually have an allocated account, physical gold stored somewhere that are U.S. citizens, I don't know how many it is, but it's certainly not a large number of people. And when Roosevelt confiscated gold, people would have gold coins jingle around in their pocket. So a good number of the people had gold. It was the national currency. I mean, today only very few people actually own gold in the United States.
That's a good point, but just because a lot of people don't own it doesn't mean they can't try to blame this financial crisis on the evil gold speculators. You know what I'm saying? So they're going to look for scapegoats. It'll be foreigners or the reason the dollar is falling or things like that, or the reason the economy is falling apart and the gold prices are going up. Oh, it's the evil gold speculators. That's not. They tend to, especially when you have a commodity price rising. They've done this in the past with the oil price. They had investigations into the oil companies. Oh, you're price gouging. When, the U.S. oil companies didn't have any control over the oil price during the major spike in the 70s, they still went to Congress and they were like, oh, you're gouging prices, when it was OPEC that was forcing, the prices higher.
Step back 2 years when 1971, when Richard Nixon, basically when he pulled the U.S. off the gold standard, off the Bretton Woods agreements, he said he blamed the fall of the dollar on the international speculators.
Which is obviously, that's a scapegoat. It's not the truth.
And people love scapegoats if you can point the finger at somebody else. And in fact, what Nixon did in that speech, if you can go back and listen to it, he made it sound like an us versus them, as the international speculators are not working for the working man, the common man. And of course, the working man, the common man, is now getting recognition from the president. And he's thinking, that's right. It's those international speculators.
Well, there was a lot of Americans back then that were buying silver, so I obviously it was just rhetoric, but the politicians always lie. State of the Unions, a lot of the promises the politicians make are just never come to fruition. I want to ask you about.
You weren't allowed to buy gold back then, as you know. When Roosevelt issued his executive order in 1933, that lasted till New Year's Eve, 1974. So when Nixon took the United States off the gold standard, U.S. citizens were not allowed to own gold.
Yeah, I said silver. Yeah, people were allowed to buy gold jewelry, and they were allowed to buy, I think, gold religious artifacts. Mm-hmm. I know the McIlvany family, I think they figured out a loophole where they were able to import gold as religious artifacts earlier in large quantities than other dealers, and that's how they made.
Blessed Krugerrands.
Well, I want to ask you about your expectations for 2016. What are some of the predictions you think are going to happen to global markets and the economy, since you cover a lot of different markets?
I've learned in the last couple of years not to make predictions because things change so fast that your assumptions just go out the window by events that happen. So I expect, as everyone else does, there to be market turmoil. But I think the big thesis of the year is what's going to happen to oil and where the chips fall there. Where do the What happens to the shale oil companies? What happens to the hedges? What happens to the derivatives? How does that all play out? I mean, that's the big. What happens to Iran? What happens with Saudi Arabia? I think it's all oil related right now.
Yeah, and to add to your point there with oil, you have to mention the commodity currency countries and the emerging markets,
Sure.
their financials there. So then, Brazil's misfortunes now, a lot of their malinvestment now and the corruption and things like that, people weren't complaining about that as much when their currency was stronger, when oil and base metals were higher. So as Warren Buffett said, now that the tides come out, you do see you swimming naked.
Well, what about Canada? The Canadian currency is down 16% year over year. That has to have an impact on Canada, but, maybe by 8-9 months from now, that'll reverse. But I don't know.
Well, I don't think it'll reverse, Lewis, unless the commodity prices start to have an enormous rebound. I just don't see any type of reversal unless we have a major the commodity prices will precede any reversal then probably in the currency. That would be probably.
Absolutely. But what I was suggesting is that if what happens, and you see it in silver, you see it in gold, companies are, and oil, shale oil as well, companies are producing like mad to stay in business. And they have to produce, as the price drops, they have to produce more to even try to meet their debt obligations. But, as you've pointed out for years now, at some point, they just go bankrupt. They won't be able to keep up. But if a lot of that happens all at once, then supply just gets shut down in any of these commodities. At that point, you then have a snapback in the commodity price because you would actually have a physical shortage of the commodity at the time when it's needed. I mean, right? I mean, At least in oil, there are stockpiles. They're floating out in the ocean on big tankers. There's so much oil. But if something like that were to happen, you have a spate of bankruptcies and production just shut down, your production numbers could just plummet. And the same with silver and the same with gold. It hasn't happened yet. And I've sent to you a few press releases from about 8 or 9 Mexican silver miners, primary miners. They keep producing. They're hitting record numbers, and they expect to do the same in 2016. But if the price gets much lower and they keep producing and they're not making enough money, if they go bankrupt, then all that silver just stops being produced. Similar to your point, as most of our listeners would know, that primary silver mining is not where most of the silver supply comes from. It comes from secondary mining from copper, lead, and zinc. Same there. If those companies stop producing or go bankrupt, then all that silver that would have been produced won't get produced. So that's where I think you might have. I don't know when it'll happen, but it's bound to happen that you'll see a snapback in commodity prices that I think will be driven not from manipulation, but just from a shortage perspective, at least a short term. And, as you know, in mining, you can't just turn the switch back on. The price rises. Now let's get those mines going again.
Yeah, mining is a lot harder to turn production back on than oil or natural gas. It's a lot faster turnaround to drill oil and natural gas wells.
And can you, Jason, talk to us about what precious metals miners are doing now in order to get to production high? What grades they're looking at and how that impacts their mining prospects in the future?
Sure. If you want to interview me, that's fine.
I know you're a good source of information. I've learned a lot from you as well, so I want to hear what you have to say.
Sure. I was just throwing a joke in there. It's well, basically what I would say from talking with people in the royalty and streaming industry who look to finance these companies, from reading balance sheets of the companies and the financials and things like that, a lot of the miners, if they're in developing countries, so if you brought up how silver production for a lot of primary silver miners in Mexico, well, the peso has been weak. So these guys, the silver price in Mexican pesos is strong. The gold price in Mexican pesos is strong. So that's not going to be a disincentive for them to stop mining. What's going to be a disincentive then is going to be their dollar-denominated debt or the fact that they've completely destroyed the mining plans at their mines. So what you have a situation with a lot of the miners is they brought on most of the mining production really after the 2008 crash. So between 2009 and 2011, a lot of these mines needed a lot higher gold and silver price than the current spot price. Some for silver needed, $22, $25 an ounce silver. Now, obviously, for gold, I would say $1,350, $1,400 gold. Obviously, the management teams at these companies have been creative they've been able to figure out ways to slash selling general administrative expenses to the bone. They've slashed exploration budgets to the bone. They've dramatically basically destroyed their mining plan to where they don't have the capital to reinvest in replacing reserves. Some companies who have good deposits, you've been able to see them cheaply replace reserves, but you cannot say that across the board. But the main thing I think we've seen, Lewis, is the high grading. Normally, and for our listeners out there who are not familiar with the way the economics of a mine work, normally when you design a feasibility study for a mine with your mining engineers and your geochemists and things like that, and there's a whole bunch of different firms and levels that you have to go through to get the mine approved financially, so you can, if you're going to use debt to build the mine and things like that. But normally, you have a certain amount of different levels of grades at the mine. So you have your lowest cost, highest grade material, and normally you make a conservative estimate in your either reserves or resource and measured and indicated resource. So there's a difference between reserves and measured and indicated resource. And normally with your highest grade, lowest cost, you don't want to mine it all at once. So if you mine it all at once, the mine's not going to be a low-cost, pretty high-grade mine for 10, 15 years, and it's not going to generate a really good investment return over the long term. It's going to get you it's going to buy you some time in the short term, maybe make you a little bit of profit in the short term. And the situation we have is, normally in the past, if the metals price was high, the miners would blend the grades and the material of the rock. So they would use a certain amount of their lowest cost high grade, maybe medium grade, that was a little bit higher cost, and if the metals price, say, at $50 silver, they're throwing in the junk. they're throwing in the junk to mine, and they're probably still making money on it. At the situation we're in now is it's been no longer economic for a while now to mine the medium grade stuff, a lot of it, and the junk. So basically, then that's what high grading is where the mine plan, where the mining engineers and all the other financial analysts and all the other teams that work together on designing the mine plan of the mine to last, 8 years or 15 years or something, and they've destroyed those mine plans to buy themselves another year or 2 or 3. And that's the situation we're in right now. I don't know how much longer they can continue to do this because they have slashed expenses to the bone. Obviously, and the thing is about mining cuts, they can't cut expenses rapidly either. It takes them, 4 months or 6 months or 8 months or a year to start cutting certain types of expenses. They can't cut them overnight. So they're running out of road, in my opinion, and they can't keep indefinitely cutting the costs and producing the same amount or more supply.
I'm glad I asked that question, Jason. I have one further point on that. Also, when they're in this situation where they don't have positive cash flow, they also have to cut their exploration costs. So not only is it going to cost them more in the future to go and get the medium grade, they won't have the easy pickings left. They'll deplete their easy pickings, but they won't have future mines that they've done feasibility studies on and will get ready for market. So it's going to take even longer for them to ramp their production back up.
Agreed. Without silver over 25, Lewis, I'm not sure there's going to be any exploration budgets for a lot of these companies. Right. Now, obviously, there's some exceptions to that. There's a few companies here or there doing some drilling. That's a minority amount. The exploration budgets, from talking to people, they've been slashed more than 90% across the board in gold and silver because the bear market for gold and silver has been longer than the other commodities have been. Obviously, oil has gone down faster than the other commodities. So, the oil market is not that far behind. We're set up for a supply train wreck. Obviously in the short term, the trend traders, and there is some oversupply in the market, but the charts, the trend traders who don't give a shit about fundamentals, they're just pushing the charts down as much as they can to squeeze every last penny out of that trade. There's going to be a snapback, like you said, at some point once firms go bankrupt and supply is taken offline. I think, one of those major firms is probably going to be Petro Dollar, the higher cost shale producers who have too much debt, who did bad acquisitions. They'll either be bought by maybe an ExxonMobil, and then their production will be taken offline, and then maybe ExxonMobil sit on the assets. So I think gold, silver, and oil, out of all the commodities, are most likely for a rally in the near future, but timing is very tricky.
Absolutely. The thing about when oil snaps back, the gold and silver miners are right now reaping the benefits of having strong local currencies and cheap oil prices.
Yep. But
they won't have that because if the oil price snaps back and they're not they won't get the benefit of, they'll have to spend more money on energy costs at a time when they're going after the harder silver and gold to get.
I completely agree. The more rock they have to move to get economic ore, the more oil or diesel fuel that they have to use. That's a great point. Steve St. Angelo of SRS Rocco brought that up. But yeah, I've brought that up to mining company executives in the past. You know, you're exactly right on that. With the cheap oil, the miners would be bankrupt too without cheap oil. Without a weakening currency and cheap oil, they would be bankrupt already. But they should hedge. They should. I mean, if you have 25, if you have oil around 30, I mean, if you're a mining company, you're First Majestic Silver or a mid-tier gold and silver producer out there, why not lock in $30 oil for your cost for 4 or 5 years? Why not?
Well, the only reason you wouldn't if you think it's going to be $15, but that's what hedging is, right?
Well, lock in then 50% of your oil needs at this cheap price, and then you can say, you know what, we have half our cost fixed. The industry just doesn't do that.
I was going to say, you mentioned that most of the mining executives are not that switched on. And if they are, it's not because they're switched on, it's because they're getting banking advice, but it's just bankers trying to sell them stuff that doesn't necessarily help them.
Exactly. And you brought this up in a conversation that we discussed, off air. You're talking about how basically a lot of these miners, the only reason they're alive is to supply the bankers with the metal and pay off their debt to the bankers, and then also for the royalty and streaming companies. So, you know, without those guys, the miners would all be bankrupt already.
Yeah.
Okay, well, I want to ask you about the gold and silver supply-demand fundamentals in the market. You know, this is a market that's very opaque. It's covert. Rules constantly change. I thought we were getting some transparency for the last couple of years. Kuz Jansen, who's a bullion star, you know, he did a great job initially finding the Shanghai Gold Exchange withdrawals. And, you know, now this news story broke that it looks like the markets are going to be back to being less transparent again.
That's definitely true. And gold has always been not very transparent because looking at gold mining doesn't really tell you much. I think I've read maybe 1% of the total amount of gold supply added through mining is it's 1%, less than 1%. So that doesn't really tell you much that if somehow, you know, gold miners shut down, there would be a supply issue. Probably not. So but silver is the more interesting one though, Jason, because as everyone knows, or people that pay attention to silver, is that most silver is consumed. Central banks don't own silver. There's no stockpiles of silver that we're aware of. People get all excited about what's in COMEX that JP Morgan has, but that's 68 million ounces. That's really not that much. And approximately 800 million ounces of silver get mined every year. That's where most of the demand gets fed from, is the current mining supply. So I think that's where you're going to see, if there's going to be a shortage, is when the miners reduce production and the demand stays where it is. And the demand, you know, until the last 5-10 years has not been in the coin, round, and investable silver. It's been industrial demand. It's been about 70%. I did a full report on silver supply and demand 2015 at the end of the year. And one of the charts that I came up with showed that industrial demand was 70% about 10 years ago of overall silver demand, and is now about 52% when you add in all of the dramatic increases from the Canadian Mint, the Austrian Mint, the Australian Mint, the Perth Mint, the U.S. Mint, and the dramatic increase in the rise of silver bars and rounds, which the Silver Institute didn't even capture in its report. So investment demand is actually starting to infringe upon the industrial demand. If there's a point where silver supply drops 10-15% in a year, overall global, not just particular countries or mines, and the demand stays exactly where it is, that's where you might have a situation where you might see the actual dynamics of physical supply and demand come into play. And if a manufacturer needs silver to meet its requirements, and it needs to pay whatever amount it is over the COMEX price, it'll do it, and it'll ignore that price. See, the difference between silver and gold is no one needs gold at any particular time. Most people who have gold have it to say they have it for an asset, but they're not using it. There's no need to have it today, tomorrow. As long as you know it's there, for most people, as long as they think it's there, that's good enough because it's reflected on in their assets is that they own this amount of gold. But silver for industry, you can't. There's no substitute for having the real thing. And I think that's where, and everybody's kind of hoping that this happens, when the silver supply and demand dynamic becomes out of balance, where there truly is less supply and more demand, that you'll see the price rise. Now, the Silver Institute says there's been a deficit for years. And they don't even include, Jason, in their demand numbers the amount of silver that goes into ETFs. So where's all the silver coming from? I think it's a combination of that the Silver Institute numbers aren't correct, and there really isn't. There can't be a shortage, a physical shortage, if people are still able to get the silver they need. There has not been we heard a couple of years ago that maybe Apple wasn't able to get enough silver for its screen, but that turned out to be just a rumor. So we haven't seen any place, anywhere, other than the U.S. Mint not being able to supply a very small amount in the overall scheme of things, the number of silver eagles that people wanted.
Yeah, I think supply shock is inevitable if the price of the metals in dollar terms doesn't start to rise, because the miners, like they have really bad balance sheet problems, they have cash flow problems, and long term, a lot of them aren't replacing their reserves like they should. They're not putting any money back into exploration budgets, so there's going to be hell to pay over the long term for this. But in terms of the physical supply of silver, you mentioned the gold stocks afloat. The thing is, a lot of that metal is in very strong hands, and we don't know how much physical gold is left in the West. So there could be a lot less physical gold than the governments are stating in the West, and obviously you're going to need a higher price in. So there could be physical gold shortages in the West, although there could be lots of physical metal in the East.
Well, look at China and Russia. I'm doing a thing right now on Russia, where Russia has basically in the last few years, I think they're the third largest gold mining country, and they've basically eaten up almost all of their gold mining production and thrown it towards the reserves. So when you see Russia is acquiring all this gold, they're not actually going out on the market and buying it and importing it. They're taking it from the domestic mining production. They're probably paying rubles for that and acquiring all that. But that means that the third largest gold mining country doesn't have much gold for export. Similarly, China is the number one gold producer. They keep all of that gold in-house. So basically, now you're stuck with Australia, South Africa, and a few other countries for your gold supply. And then you have South Africa cutting back on production. That's where you could have supply shortages. But as I mentioned earlier, the mining production isn't really where all the gold comes from. Central banks hold about a third of the overall amount of gold in the world. There's gold. It comes out of hiding when the price rises, if there is some type of shortage. Whereas silver, I don't think there's enough silverware sets and American Silver Eagles to meet a shortage in industry, a real shortage in industry demand, that silver would be able to come to market quick enough, be melted down and shipped out.
And that silver is not going to come to market to be scrapped from silverware and grandma's, China and things like that. It's not going to be scrapped at $14 an ounce. Now, There was a good amount of that at $50, though.
Absolutely.
A lot of it came loose. Yeah, a lot of it came out of the closet and, the attic and the basement and stuff at $50 silver. But, I don't know how much will be left of that if we go back up to 50, because a lot of it was probably already sold at the 50 at the last time. It was probably all done.
I wonder how much junk silver is actually available. It hasn't been made in 50 years. A lot of it's been melted down. Junk silver, we're talking about, it's the 90% silver coins minted before 1965 in the United States, the dimes, the quarters, the half dollars, and the Morgan and Peace dollars.
Silver is very difficult to recycle. It's not like copper or steel or things like that, or aluminum, where it's a lot easier to recycle. A lot of silver is sprayed in nano spray, or it's in very tiny contact switches. It's very difficult to get the silver out of the electronics or things like that to recycle it. So a lot of it just ends up in a landfill or in the ocean as little tiny bits. So it's not easy at all to recycle silver.
And definitely not economic at $14 an ounce.
Oh, I don't even know if it's economic at triple
Right.
digits. Some of the yeah, I don't even know if silver stayed at 100. I'm sure there would be a new business opportunity to figure out how to get silver, out of the ocean or out of the
Right.
junkyard.
Or they
And
won't be doing meteor mining like they're planning, or they were planning to do for gold and platinum. Going out in outer space and mining rocks up
well,
there.
they may the environmentalists may consider that more environmentally friendly though, because then we're not wrecking the earth.
Right,
We're
the universe.
just we're just chucking the stuff into space then, right? Anything
Right.
we mine, the robots that mine it then will throw it into space
But
then.
not for $14 an ounce. You're not going to undertake that.
Oh yeah, definitely not. Definitely not. Although platinum and palladium are high enough at that price, but if there was a free market in water and the price was allowed to be a free market and there was clean water and stuff, they may be able to mine asteroids sooner. But the market is not allowed to be a free market for water, and there's a government regulation. That's why the water isn't as clean as it should be. There's not a free market in pricing. Government subsidize it and things like that. But that's another conversation. I want to ask you now about how much longer you think then that the gold and silver markets can keep going down. We talked about the miners and their situation. Are we going to be looking back like 3 to 5 years from now and saying the same exact thing then?
My answer is going to be until 2012, because that's when I thought this would last, the entire QE and the monetization of debt and just the debt that the United States has. But it seems that there's almost an unlimited amount of tricks and credit that can be issued, that it just keeps going. I've never been one to say imminent collapse or this or that, because I've seen them pull the rabbit out of the hat many, many times. So
Yep,
we can all say at some point inevitable, sure. But I'm not a Keynesian, but he's right. In the end, we're all dead. When does that point happen? It's just been years. You would think it's unsustainable, Ponzi scheme, but it's a long Ponzi scheme.
Yeah, they just keep moving the goalposts and changing the rules, and GDP. There's always deflation, even if the asset prices are rising, even if your tax bills are going up like crazy. All your property taxes and car vehicle taxes and Obamacare tax, and there's taxes layered upon new layers of taxes upon layers and layers of taxes and things like that. And your food prices, they just come up with new ways to shove the dead body under the rug. Well, actually, it's dog poop under the rug. That would be
well, most people aren't paying attention, and I think that's the mistake that we make, people who follow these things very intently, is that the rest of the world is paying attention and cares. They don't. It's just, they're satisfied with the way things are, and we may laugh and mock when we hear mainstream media talk about the economic recovery. People believe that, though.
Well, what I would say, Louis, to counter what you said the rest of the world doesn't care. I would say most of the United States, people in the United States don't care. And I would say the rest of the world, our listeners out there who are global, a lot of foreigners get it.
Yes.
Like they understand,
yes, I agree.
Like they've had their currencies fall. We have a lot of listeners who live in many different countries. They've experienced, problems with currencies and things like Americans have never experienced anything like that, unless they've traveled abroad and they were living, in another country for a while. So, Americans are in general very spoiled with how good things have been for so long, for the most part.
Right?
Yeah. Well, compared to other countries, yes.
Totally.
Well, I think that about wraps it up for today. I could speak with you about the gold and silver markets for a while. It's just really frustrating for someone, who wants free markets and honesty and transparency. And then here you go with a country like China. We're getting legitimate withdrawal numbers that were legit from the Shanghai Gold Exchange. Obviously, that didn't count, I think, the Chinese government buying their own physical gold from other markets and things like that, trading their U.S. dollars for physical metal. But at least we were getting some transparency, and then here we go again, another rules change, and now we're left holding holding the bag.
You can only guess. Free markets only work if there's freely available, transparent information, reliable information. That used to be why the United States Stock Exchange was the place to be, because supposedly you had transparency of financial statements, you had reporting requirements, you had audits. But ever since they've done the mark to fantasy rules and the bailouts, and you have the plunge protection team, and the United States market is no longer one where you can trade. It's algo trading and flash crashes. It's no longer the place where you can sit down, look at a company, analyze it, and pick your spots to buy shares. Because you have these unicorn stocks, they go up no matter what. And I think it was Craig Hemke. He basically says that the stock market is just tied to the dollar-yen movements. It's algorithmic trading.
Well, the general indices maybe, yeah, but not individual stocks. That may be different.
Well, but they make up the indices, though.
Well, what I would say though is the indices. A lot of the indices though are only made up though, Lewis, of like a handful of companies now. So you have a situation with the FANG stocks like Facebook, Apple, Amazon, Netflix,
they trade
Google.
As a group now.
Yeah, they trade as a group, and they make up the majority of a lot of these indices now. But I'm talking like other individual companies. If a company puts out a press release and it's not about making money or something, but it sounds good, these computer trading algorithms, right? They scan the press release and say, oh, that's good news, even though it's just like a puff piece, and the stock goes up. And the real underlying businesses like the royalty and streaming companies, which should trade at a higher multiple, those things just don't. So it's very frustrating out there. Unfortunately, all I see going forward is more volatility. I wrote in my report, which you read, I would be shocked if there wasn't a market crash, a meaningful correction or crash before the November elections. I don't know how they're going to be able to keep it up. Because, they've been telling everyone for the last couple of years now after the reflation and the quantitative easing programs, look, the economy is recovering, right? Oh, the economy is recovering. There's green shoots, blah, blah, blah. Oh, unemployment rate's low, blah, 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 blah. And, now we see the fact that the majority of net jobs that were created in the United States, almost all of them were the high-paying full-time ones were shale oil jobs. Mm-hmm. So those jobs are gone. So where were the high-paying full-time jobs that were created in the United States? Maybe they're in Silicon Valley. That's a small amount compared to the rest of the country. They're just not. Most of the jobs are part-time jobs.
And those part-time jobs, if you look at the civilian labor force participation rate data from the St. Louis Fed, you'll see the bulk of the job gains are to those 55 and older, 65 and older. They've shown tremendous percentage increases in the labor participation rate of those groups since the Great Recession, whereas those aged 25 to 54 have seen a decrease in the labor force participation rate from 2008 and 2009, which means a lesser percentage of millennials and people in that age bracket are working now than they were at the height of the Great Recession. That is not a recovery. The older people are getting jobs because they can't afford to retire, have to come back out from retirement to go work in a part-time job at Home Depot. If you ever go to the big box stores, when I was a kid, it was all people my age and maybe somebody who was 30 years old who was the manager that worked in grocery stores and big stores. You go today, it's all senior citizens. And
welcome to
dystopia, right?
Welcome to dystopia. That's what I was going to say. My generation, which is Generation X, or I guess you could I'm not sure how they qualify the millennials, but I'm more of a Generation Xer, I guess, which is a little bit older than the millennials.
They're Gen Y.
But those generations are pretty screwed now. I mean, a lot of my friends, and I live in one of the highest average median family income counties in the country, Fairfax County, which is like 15, 20 minutes outside of D.C., and we have 3 of the 5 richest of those counties in the average median family incomes in the whole country. And, there's a lot of people that are adults my age. They have 1 or 2 college degrees. Some of them even have masters, and they're working like 2 or 3 part-time jobs, and their wife is working 2 or 3 part-time jobs just to have anything. And what's coming down the pipe, and this has happened with me, unfortunately, in my life from working too hard, is that, they're working hard now, and maybe they have a little bit of savings, and, they bought a house maybe, and maybe they're starting a family. They're going to get sick because they're not sleeping as much. They're working, 2 or 3 jobs. I don't really know how you can work 2 or 3 part-time jobs and actually get a good night's sleep and have like normal functioning health and things like that. People are going to pay for this down the line.
I agree.
And it's gonna hurt the healthcare costs even more.
And which in turn hurts the economy. Although the way GDP is calculated, the more people spend on healthcare, that adds to the GDP.
Yeah, they'll just, I mean, if anything that hurts GDP, they'll just reweight something or change the formula anyway.
Same with inflation, right, Jason?
Exactly. Well, GDP, inflation, the jobs numbers, all the data, and it's not just the U.S. government. Chinese government does it too. Europe does it too. Pretty much everyone has phony data.
Did you see that Argentina was honest enough to declare what's called a statistical emergency because the government felt they couldn't trust their own numbers?
Oh, really?
Yeah. I wish the United States would declare that.
Well, maybe they shouldn't have made a prison sentence because in Argentina, if you were John Williams of Shadow Stats and you were putting out different inflation numbers and unemployment numbers in Argentina, you would have already been in jail for a while. So it was a criminal offense to challenge the government numbers. That's hilarious. You told me now that they've even admitted that they need a more honest transparency. Well, they would have had it if they wouldn't have threatened a jail sentence. Yeah, but all the honest people were afraid to speak up, right?
Maybe one day people who are peddling fiction, as President Obama says, will be jailed.
Well, in the United States, yeah, they're on college campuses now. There's a lot of hardcore progressive kids, and these are kids that either love Hillary Clinton or Bernie Sanders. They hate capitalism because they don't even know what it is, and they love socialism, and they've been taught by their Marxist professors and things like that. A lot of their Marxist professors, and this is why Bernie Sanders is popular, and they want to ban any type of dissent or argument. They want to limit free speech or eliminate it and regulate it and, penalize people for it. This is the world we live in now. This is dystopian, unfortunately.
Yep, and it really has to do with its education because from the time you start kindergarten till you go to high school till you go to college, that's the indoctrination plan.
Exactly, and this is one of the main reasons I still do this podcast is I'm hoping out there that, one person will listen to it and wake up, or maybe they'll tell their friends and things like that. So, education is one of the main reasons I think this problem gets solved because this problem is so big on so many different levels. There's so many problems in society, whether it's the financial system or, the pharmaceutical companies or even the food we eat now. A lot of the food we eat that's processed is poison.
Jason, what it comes down to is people have been taught that big government, not just government, has the solutions. So once you take that point of view, then you want the big government to come up with a big solution, which usually means big tyranny. It means ban this, force people to do that, tax them on this, and that's where you have the issue because people believe rather than finding individual solutions, local solutions, community solutions, that there is or now it's not even just a national federal solution, it's a global solution. And once you place your trust in some behemoth that's going to make a global solution, you just given up all of your freedom. You're going to expect some global entity or a national entity to figure out and not only what the problem is, but what the solution is.
Yeah, there's a lot of book smart people in this world in the United States, especially, but they have no common sense. And they memorized the textbook. They took all the best lecture notes. They didn't skip any class in college, and they did a good job, regurgitating the stuff, but they can't think independently for themselves. They don't see the other viewpoint properly.
Well, they're not even taught the other viewpoint. I mean, you can't even take an Austrian economics course in many universities. They don't even exist.
Yeah, exactly. And then when they get into the financial world, anyone Austrian school economics is wrong. Well, have you even read any books about Austrian school economics? Have you even listened to one of Ron Paul's speeches or Rand Paul's speeches? No, you've just labeled him a crazy guy because he mentions gold or silver once. And it's like the stuff they do the same stuff with Dr. Mark Faber. I've known Mark for a few years. I've interviewed him a lot, and they call him a permabull, which is not true because in 2009 he actually said that the stock market was going to start going up a lot.
I remember that.
Yeah, he actually said it was. Now he hasn't been right on everything, but he's always preached at least some diversification into like stocks and bonds and real estate and metal.
He's not have you ever heard of the Burgermeister Meisterburger?
No, but
that's what he sounds like.
Oh, well, I actually I put a picture of Dr. Doom, the comic book, going with him.
Oh, okay. So I like listening to him.
Victor Von Doom, yeah, I put a picture next to him with that. But he's labeled by, I see on Twitter and I hear it like on the mainstream financial media, on CNBC and Bloomberg. Anytime Dr. Mark Faber comes on, he's the perma bear, right? not being objective or patient listening to him. And you're saying this before we start recording, how stupid the mainstream media has gotten and how, good the content should be, where you and me can have an intelligent conversation. And if you disagree with me, that's fine. I could tell you why, I think you're wrong, or you can tell me why you think I'm wrong. And, that doesn't occur now in the mainstream media. They control the narrative. It's all 2-minute sound bites or a bunch of BS.
You know what the problem also with the mainstream media is? That the alternative media is controlled by the mainstream media, in that the alternative media does a good job responding to mainstream media stories. But that's mostly what they do. They respond to some of the stories, most of the stories, that the mainstream media puts out there. So in effect, they're still controlling the narrative. You may have an opposing point of view, but they're choosing the stories. They're the ones putting out the information. What I'd like to see is the alternative media creating its own news and putting that out there and ignoring some of these ridiculous stories. See, I think it's tempting. You hear a ridiculous story in the mainstream media, and everybody wants to comment on it, criticize it, but you keep that news alive by doing that.
Well, I think we can end on that. We've gone to almost an hour. I really enjoyed this discussion, though, Louis.
Thank you, Jason.
Please tell our listeners more about Smaugald and that small, like Smaug the dragon from Lord of the Rings. Please tell our...
Spelled SMAULGLD.com, Smaugald.com. I put out 3 or 4 articles a week on gold, silver, real estate, and the economy. So check it out at Smaugald.com. You can also subscribe, and I'll send you the blog post the minute they're published.
Okay, great. And yeah, Louis does a lot of good work out there for our listeners. He really challenges some of the other gold and silver experts. He reads very widely. I discuss a lot of articles from Steve St. Angelo with him and with Ted Butler. So Louis is extremely well read. I think he's very underrated for precious metal experts. I'm surprised, he's not on like Greg Hunter or Cherd Ferguson a lot more. He should be on those, like unlike some of the other experts. He should be in that group at least, where he gets more say and more interviews on those channels.
Thank you very much, Jason, for those kind words.